Hello everybody, this is Toni Turner and welcome to the Market Now as of the market's close on Friday, February 1st. Before we go on, please know that I will be speaking at the Orlando Money Show this coming Saturday, February 9th from 2 to 2:45 p.m. on how to swing trade successfully. For more information, go to moneyshow.com. And now on to the market. U.S. job growth surged in January, with employers hiring the most workers in 11 months, pointing to underlying strength in the economy despite an uncertain outlook that has left the Federal Reserve wary about more interest rate hikes this year. The Labor Department said its monthly employment report today showed no discernible impact on job growth from a 35-day partial government shutdown, while acknowledging it was unable to quantify the effect on private industry. The report came 2 days after the Fed signaled its 3-year interest rate hike campaign might be ending because of rising headwinds to the economy, including financial market volatility and softening global growth. And on that note, let's move into 3 charts that might give us some insight into the week to come. First of all, as we normally do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. As you all know, this is the exchange-traded fund that closely follows our S&P 500 index. We use it because we can see volume on it, for one thing, and it's tradable for another. You can actually trade this ETF. So let's see how the S&P 500 is doing. Now, we all know that on December 24th, the benchmark melted down to lows at about 234 or 2340 on the S&P 500 itself. Since then, it has rallied in a very, very powerful rally, very nice, powerful uptrend, I should say, higher lows and higher highs. And today, it closed at $270.06. or 2,700 on the S&P 500 index. Now, this has given us about a 15% advance from these Christmas Eve lows. So that's pretty good. Now, the SPY is over the green line, the 50-day moving average, the red line, the 20-day moving average. It's still beneath the 200-day moving average, which is moving horizontally. Shouldn't give it as much trouble as it would if the moving average were moving down overhead. However, we see the 200-day is coming in here at $273.88 currently. We also have this resistance point up here that started in October, November, December. That's up at about 280 or 2,800 on the S&P 500 itself. So far, this 280 has posed a pretty strong ceiling on the index, so we'll have to see what happens when and if it returns to that levels. Now, on the RSI, we look down here, we can see that the RSI is not quite but almost in overbought territory. The RSI, when it moves up to or above the 70 line, which is this line you see right here, that means that whatever we're looking at is overbought. It's not quite there yet. And if we look back here in August, September, July, we can see that the RSI can stay overbought for some time, or at least near it, while an asset, ETF, whatever we're looking at, is moving higher. So while it's no cause for concern, what I do see here that may be a little cause for concern is that this rally it's been wonderful, it's been fun, it's been very positive, but it's also moved up at a very steep angle. Very little give and take here, almost as though there was, and I'm sure there was, quite a bit of short covering on this move up on December 26th. So, because of the angle of this rally, now it has consolidated here right around the 260 line. We do have support at about 260, 261. Of course, right here where the 50-day moving average is, the 20-day crossing the 50, that's positive. So this area in here, 260, 261, is offering potential support. The 200-day moving average offering potential resistance, and certainly this 280 line might be a tough one to get over, but we will see. We will see. Maybe not. So while the market certainly looks positive at the moment and volatility is abating slightly, the market is still a little bit nervous here if I look at the VIX, so I am, as usual, trading with very firm protective stops in place. I don't want to give back the gains that we've gotten from this move up. Our next chart that we're going to look at today is a chart of the iShares Russell 2000 ETF, the IWM. In Tony's Market Club, we watch the IWM weekly for sure. Now, this is made up of small caps, companies valued at about $300 million to $2 billion. The IWM, or small caps, are known to potentially act as leading indicators for the broader market. So that's why we keep an eye on the IWM. Now, as you all probably remember, the IWM made an all-time closing high on August 31st at $173.02. Since then, along with the rest of the market, the IWM has fallen dramatically, falling to a close down here on December 24th at $125.84. Now, that was 27% below this August high, so that was a pretty big fall, pretty big meltdown. Since then, however, the IWM, being the drama queen she's always been, has risen dramatically and moved into a strong uptrend and closed today at $149.18. So it's moved up almost every day, being positive since that day after Christmas in December. Now we're back up. We're back up into this territory here, which is a good thing, above the 50-day moving average, which is now coming in at 142.78. Certainly above the 20-day moving average, which is crossed above the 50. That's a positive sign. So now the IWM is back here, up in this territory here, and I did draw a trend line coming down here, as you can see from the top, down over this high, and stretched it all the way down. So we can see that in the short term anyway, the IWM has broken above some of these barriers that it had before. Now the important thing is, can it stay there? Can it stay here, I should say? It is slightly overbought on the, or becoming overbought, I should say, on the RSI, as are the other indexes, and most sectors right now have a very similar pattern to this one. Now, in the last couple of weeks, it's had a consolidation pattern here, kind of gaps up, gaps down, not sure where we want to go. And so, again, we have price support at 142 at the 50-day moving average, more support at 144. Now we have to see if the IWM can climb up, go over to 150, excuse me, get through some of this area here, which could represent some selling, some resistance. We'll have to see how strong it is. If it can now keep going back up, at least at some point here, get over these highs at about 154 and climb back up to 158. So do keep an eye on the IWM in the coming week. As we said, it's a pretty decent indicator, leading indicator for the broader market. So keep an eye on it for further clues as to what the broad market might do. Our final chart today is one I don't think we've ever seen before. But I looked at this because so many of the sectors, ETFs are so overbought right now. And I was looking for where the next move might come from if, in fact, this market does take a little breather. I'm looking at the United States Gasoline Fund, the UGA. Now, the UGA is an exchange-traded security that is designed to track, in percentage terms, the movements of gasoline prices. Now, I will tell you that this particular ETF and others like it is best traded in an IRA or a tax-advantaged account because the IRS considers this to be a commodities trade. This fund follows commodities, commodity indexes for RBOB or gasoline. It is actually a positive taxation for you, but if you or your accountant doesn't know how to calculate it, again, you're better off purchasing shares in an IRA or a tax-advantaged account. So now let's look back at the UGA. If we look back, and you can't see it on this chart, but if you take a longer-term chart and go back to 2017, you will see that the UGA fell to a low of 22 back in June of 2017. And then, since then, it's moved in a really rambunctious uptrend. It kind of went sideways here on this chart from May all the way through its high here in September. And it touched highs up here at about $37. And if we look left on this chart, a longer term chart, you'll see that it did that too in about May of 2018. So May and then October, a little double top, and then it fell dramatically, eventually touching lows of 22.05 on December 26th. That's a 40% drop in gasoline. In fact, I was surprised the other day. We had gasoline at $1.96 in the town where I live. That's $1.96 a gallon. Is pretty cheap for around here. Since then, since these lows in December, it has come back up and made a pretty decent pattern. See this pattern here of support right around 24. It fell back down. It held except for a couple of days, and it's back up now, closing today at 24.80, above the 50-day and the 20-day moving average, with the 20-day moving up, trying to move up over the 50-day. That's a positive signal as well. Now, this ETF, the UGA, does not have enough volume in it to day trade it. I do want you to know that. However, it does look like a pretty decent short-term, maybe longer-term trade in the coming weeks here. It is a bottom fishing play. I will tell you that, so you want to keep a tight rein on your stops. It, again, is trading today at 24.80. It closed at that. If it does start up in coming weeks, let's say it can move over 25. If it moves over 25, I am going to buy a small position for my portfolio. Then if it can continue up and move over 26, I will probably add shares to my position at that time. I'm going to have an initial stop right now as a close below 22.80 will be my stop, a close below 22.80. When and if it continues to rally, I will add shares again above $26.20 and raise my stop if it keeps going up to a close below the 50-day moving average. So I keep raising my stop here. You can raise it wherever you want, but the point is if it starts up, you want to keep raising it to lower your risk. So you may want to keep an eye on the UGA in coming weeks to see if buyers come in and start pushing it higher. And now for this week's economic reports, but first, please join us this coming Monday, February 4th, for our next session of Tony's Market Club. If the market's moves are confusing to you right now, please let us help. In our weekly sessions, we talk about which side of the market to trade and what to watch out for, and I'll give you stocks and ETFs to trade along with entries and protective stops. These trades may be ripe for high potential trades, and we've been doing very, very well. Tony's Market Club is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend the live session, no problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. We are still in earnings season. However, next week we also have just a couple of economic reports. Monday we have auto and truck sales. Wednesday we have crude inventories. Thursday we have jobless claims. Again, join us for Tony's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.